Hello class, we are now going to look at the accounting equation, and the accounting equation is the foundation for the balance sheet. And we're going to do two things. We're going to look at how the accounting equation works, and then we're going to talk about some of the accounts that you will find under each one of the categories of the accounting equation. So this is the accounting equation. And the thing about the accounting equation is it always balances. It's a rule that absolutely never changes. It always balances. So the basic accounting equation is assets equal liabilities plus equity. And assets are things like things that a company owns that provide a future benefit, like furniture, fixtures, buildings, equipment. Liabilities, you're probably familiar with, are things that the company owes. So accounts payable, notes payable, wages payable, taxes payable. By the way, do you notice a word in common there? Liabilities usually have the word payable after them. And then equity is a little bit interesting. So the idea with equity here is that if we sold off all of the assets to pay off all of the liabilities, what we would have left is the equity. The idea behind equity is that that's what we have in the company left for the owners. But we're going to work on expanding equity a little bit. So if we look down on the bottom here, the expanded accounting equation, we have assets equal liabilities plus equity. Okay, under equity, we have two main components. We have contributed capital and retained earnings. So contributed capital, if it's a corporation, is common stock. If it's not a corporation, then it's capital contributions made by the owners. That's contributed capital. Retained earnings has to be part of net income. It has to be earned by the company in its normal course of doing business and then retained in the business. That's retained earnings. Now, under retained earnings, we have three elements that affect retained earnings. Dividends decrease retained earnings. So dividends are if we give money back to the shareholders out of the company, or if we give money back to the owner out of the company, that's a dividend. Dividends decrease retained earnings. Revenues increase retained earnings. So if we earn revenue, we increase retained earnings. And the way I think about that is if I'm an owner and my company is profitable, right? If I make a sale, then I now have more profit for me, right? Because I've sold something and part of it's profit, so I have more retained earnings. Expenses decrease retained earnings for the same reason. If I incur an expense, I have less left over for me. So we have assets, liabilities, and contributed and equity. Now, let's look at how the pieces work together. We can rearrange this accounting equation algebraically. I mean, assets equal liabilities is the same as assets minus liabilities equals equity, or assets minus equity equals liability. You see where I'm going with this. But because it always balances, let's look at Bose on the very top one. Assets equal liabilities plus equity. If we have $150 in assets and $30 in liability, and there's a homework question and a practice question exactly like this. If we have $150 in assets and $30 in liabilities, how much do we have in equity? You should have come up with $120. And I get that because $150 minus $30 gives me $120. So now I balance. I have 150 on each side. Okay, let's try Vogue. So Vogue, we don't know how many assets they have, but we know that they have $100 in liability and $300 in equity. So how much should Vogue have in assets? Hopefully you said $400 because 300 plus 100 is 400 and the two sides have to equal, so they must have $400 in assets. All right, let's look at the bottom one. Let's look at the expanded accounting equation. Now, this gets a little bit trickier because the assets still need to equal the liabilities plus the equity. But now we have to figure out what to do with the equity. So if we look at Tesla, we know that we have, I'm getting my calculator here because a calculator is going to be really handy. You should absolutely be having your calculator out when you're doing the schoolwork. All right, so we know we need to come up with 200. Well, I have liabilities of 80, so I'm going to add 80. I have equity of 120, so I'm going to add 120. I have $100 of common stock. Oh wait, so I need to make, my mistake. Let's just look at equity. Equity is $120. Common stock minus dividends plus revenue minus expenses should equal equity. That should equal $120. So I need to get to $120. I have $100 in common stock. I'm going to add that. I have nothing in dividends, so that doesn't matter. Expenses decrease equity. So I have to subtract the $40. So now I have $60 in that yellow part. But how much do I need? I need to have $120 in equity, but I only have 60. So how much should my revenue be? Hopefully you said $60 because now 100 plus 60 minus 40 is the 120. All right, let's try the YouTube one. So now I have equity of $240. I want all of my equity to equal $240. Now you work through it, and what do you come up with? Hopefully you came up with dividends of $10. So 220 minus $10 plus 120 minus 90 gives me my $240 in equity. Now, I want to also point out, if you look at Tesla, the assets equal the liabilities plus the equity. $200 in assets, 120 plus 80, $200 in liabilities and equity. And for YouTube, 400 in assets, 160 and 240 is $400 in liabilities and equity. Always balances. I wanted to show you an announcement that I put on our course that you can use right here. So in this announcement, I've added a lot of the common accounts that you'll see under assets, liability, revenue, expense, common stock, and dividends. This is a really, really, really good list for you to become familiar with because these are the common account names. Now, I want to point out a couple of strange ones. Under assets, if you see prepaid expenses, and I do describe it down here, but prepaid expenses, that is the only account that has the word expense that is not an expense. A prepaid expense is an asset because it means that we paid an expense in advance and we're going to get the benefit later. An example of a prepaid expense is if we paid rent a month in advance. You know, like if we leased a space and we gave them the first and the last month's rent, that last month's rent is prepaid rent. It is not an expense yet, it's an asset because we are owed something in the future. Under liabilities in red, you'll see unearned revenue. It's the only account that says revenue that is not revenue. Unearned revenue is like when a company gives us a deposit ahead of time. So when they give us that deposit ahead of time, we haven't earned that money yet. I had a cushion manufacturing company. Hilton would give us ahead of time, you know, $5,000, $10,000, $20,000 deposit. That's not revenue. That's unearned revenue. It's a liability. It's a liability because we owed them something. They were either going to want their cushions or their money back, but we owed them something. That's unearned revenue. Under expenses, I wanted to point out one that doesn't have the word expense because most of them do, and that's cost of goods sold. And we're going to look at cost of goods sold more in the future. It has to do with the value of inventory. When you sell inventory, it goes into cost of goods sold. So this is in the course announcements. It's a really good cheat sheet. I shouldn't call it that. I mean to call it resource sheet. It's a really good resource sheet for showing you the expanded accounting equation and also kind of reminding you of the common accounts that you will find on that expanded accounting equation. So thank you for watching. The next video, we're going to dive into some actual examples of applying the transactions to the accounting equation.